expertise in both corporate and individual revenue. It's a turnaround management, a member of the Turnaround Management Association, and it's won 2 awards for its activities in 2020, as you can see. I'm now going to hand over to Dave Saddington, who will run the first session, which is covering government schemes and changes, as well as hints and tips and things to keep an eye on. Dave, over to you.
Thank you, Sherry, and good morning, everybody. And next slide, please, Tom. What I'm going to cover today is what government schemes, first of all, what government schemes have either been made available or are still available. And just to let you know that through the British Business website, you will see all of this information. So I'm just doing a bit of a run through, but full information and authorised lenders are available on the website. So the bounce back loan was introduced by the government in May 2020, and it's actually expired on the 31st of March 2021. Most of the time, in fact, I'm pretty certain all of the time, your own bank would have made this facility available. It's 100% government guaranteed, but the business is still 100% liable for the debt. It was for loans between £2,000 and £50,000 on a self-certified basis, typically against 25% of turnover for the previous year up to December 2019, and it's got a 12-month capital repayment holiday. 1 in 4 businesses have got one of these loans drawn down. Now, just a bit of update information on this. The bounce back loan, the government introduced a pay-as-you-grow scheme, which was introduced to spread repayments with 3 options. One was to request an extension of the loan term to 10 years at the same fixed rate of 2.5%, which you're just not going to get that 2.5% on any business loan that I've ever come across, unless it was fully secured against property in the past. And my advice would be to take advantage of these, even if you felt that the business was still going well. You know, you've got the 12-month period of time to actually have the repayment holiday. And also the second option is to reduce the monthly repayments for 6 months by paying interest only 3 times in the term of the repayment. And you can take a repayment holiday for up to 6 months, only once in the term of the loan. Next slide, please, Tom. I think you've gone one too far there. The next slide should be the CBILS loan. There we are. Okay, now we all get told to stop abbreviations. I think everybody does know what CBILS loans stand for, but just in case you don't, it's the Coronavirus Business Interruption Loan Scheme. Now, this was a further advance of a loan that the government introduced shortly after, really, the bounce back loan came out. And again, it was for 25% of turnover to December 2019, or twice the annual wages figure. There's 110,000 loans taken out by businesses in the UK, and also the Chancellor has confirmed that repayment and the government guarantee can be extended to 10 years. It expired on the 31st of March 2021, so applications are now closed. Originally, it was a 6-year repayment term, 12-month capital repayment holiday, and importantly, the government would pay the interest and fees for the first year. 80% of the loan is guaranteed by the government up to, and there is no requirement for a personal guarantee up to 250,000. If it was over 250,000, then the lender would actually negotiate taking a personal guarantee from the directors of the business. Next slide, please. We need to go back to recovery loan scheme. There we are. Okay, now the recovery loan scheme, spend a little bit more time talking about this. I mean, basically this was provided and launched from April 2021, and it's still available for applications through to the 31st of December this year. Now, we don't know at this stage, the CBILS loan, if everybody was aware, was extended, I think, at least 2 times. Now, I've not heard any rumours or any plans to extend that date, so applications would have to be in by that date. There is always a little bit of an allowance after that time of a month or 2 to complete the applications, but that is the expiry date that we've been told, and is all information is on the websites. So the interest, this is a subtle difference. The interest and fees are payable by the business from the outset on this loan facility. Terms again are starting off at up to 6 years. The annual effective rate of interest and upfront fees cannot be more than 14.99%. My advice is always to go to your bank first, because they should be doing the loans at significantly less than that, probably in the region of about 5-6%. And then if you go to an alternative funder, there's a cap there of 14.99%, which is good. The government guarantee is still in place for 80% of the finance, but again, the borrower is always liable for 100% of the debt. We'll come on to serviceability and proving what you've got to do to actually get any loan facility later on in my presentation, but up-to-date financial accounts and projections to prove repayment are an absolutely must, and the business must be considered to be viable. Next slide, please, Tom. And the next one. Okay, now the Northern Powerhouse funds are again part of the government scheme to back up the Northern Powerhouse vision. The government believes that SMEs form the foundation of the region's future growth, and are launched by the government-owned British Business Bank. I have regular meetings with the local funders to understand the due diligence around these, and again I'll come on to how you actually support an application and what we can actually do later in the presentation. But to start off, the Startup Loan Scheme has always been available, and it was before the pandemic, and that's available for businesses in the first 2 years of the business being established. And effectively, this is a personal loan for each person involved in the business, whether it be each director. So if there's 2 directors in the business, then essentially both directors can apply for a loan each. Now, I've not put it on there, but just as a reminder that it's a maximum of £25,000 for a startup loan, but that doesn't mean to say that you automatically get that. It is subject to due diligence, and the average loan size is somewhere between £7,000 to £10,000. But you're not going to get a better rate of interest than 6%, which is a fixed rate of interest. There's no fees. It's a 5-year repayment plan, and there's also involved in this 12 months free mentoring. So it's a very worthwhile way to support new businesses. Then moving up the scale, there's microfinance available for £25,000 to £100,000. That could also include startups as an additional funding to that, but it's typically there for good quality growing businesses. Then there's debt finance available between £100,000 and £750,000, there again for growth business and backed up by strict due diligence to support the application. Next slide, please, Tom. Also available under the Northern Powerhouse funds and supported by the British Bank is equity finance of £50,000 to £2 million. These are for innovative and fast-growing businesses, and obviously with it being equity finance, they'll be looking for a share in the business. And as I've mentioned before, the recovery loan scheme is still available, and it's probably the go-to first form of finance that you need to be looking at if you are looking for a loan fund at the present moment in time. Now, we're also working on angel investment sources. So we've got access to local networks for good quality businesses. And to do that, you would need a business plan, a pitch deck, and financial projections to back up the application. Next slide, please, Tom. Okay, now finance applications and good practice. Really, from my background in banking and alternative finance, I'd always say that you should be maintaining as good a relationship with your bank and accountant as possible. Your bank should always be your go-to person, but individual. But obviously, if they say no, then you've got to look at alternatives, and that's what we're here for and available for you to speak to us. Or indeed, if you've actually put the application to the bank and it's still considered to be a good application, I've helped many businesses actually been able to overturn a decision, but there's no guarantee, unfortunately. But please maintain good communication, and these people are, most of the time through the banks, you're paying fees, and you certainly be paying fees to your accountant. So utilise that professional support. Moving on to the financials, that's what your accountant's there for, to make sure your annual accounts and your management figures are all up to date and submitted on time. And also for any loan application at the current in any time really, but especially now, they'll be looking for at least 12-month projections to actually prove serviceability of the loan. Loan repayments, there again, will want to the lenders will want to see proof that your existing and new loans are being repaid and can be repaid, and also are you up to date with your tax. And next, one of my favourite subjects is credit ratings. I will always ask any business whether they know what their credit ratings are, but you know, if you don't know, then you need to find out. And probably more importantly, if your business rating is quite poor, maybe, you know, it's marked out of 100, if it's down around the 30 mark or below and you're cautionary, what can you actually do to improve that? Because there are ways to improve your business credit rating. And refinance, make sure that we work together on all the options to help you look at raising finance. It may well be that you've got assets in the business. I've come across a business recently who'd actually been able to go out and buy pretty much all of the assets. So it was a printing business. They'd brought their items outright in cash. But when I spoke to an asset finance provider, they were quite happy to actually refinance against those assets and actually release cash into the business. Okay, that's me done. If I just really, in summary, was just to say that, reiterating what Sherry says, that please contact us. It's a free service. We'll work with you over a period of time. You know, a time is to suit yourself. Alternative funding options, they are out there. You know, we are unable to advise and recommend on certain, you know, a lot of lenders, but you could also, there is an option to use a broker if you wanted to go down that route as well. And we've got other services to support the business as well. So thanks for listening. I'm now going to pass over to Colin Saville.
Good morning, everybody. Firstly, like to say thank you to Cheshire and Warrington Growth Hub for inviting me to speak this morning. Perhaps if I could get our first slide, Tom. So as Cherie has hinted earlier, while we term ourselves as business recovery professionals, we are in the business of prevention as well as cure. So what I'd like to do this morning is make a few comments about how you might be able to manage the risks in your business and indeed potentially insure against them. Also make a few comments around maximising your available liquidity and any factors which may affect the amount of that funding that's available and the exposure for you as the business owners. I'd then like to talk about mediation and negotiation, which both on the legislative front and I think in the real world is going to become important in dealing with business debt and challenges going forward. And then I would also like to speak about the effects of the Coronavirus Act and the Corporate Insolvency and Governance Act, which were passed last year, how that's impacted on debt enforcement and available processes. And then speak towards the end on both lighter touch rescue processes and retaining a viable business via a proper formal insolvency process. So if we go to the next slide, Tom, please. So in terms of managing and insuring against the big risks in a business, clearly minimizing bad debt is essential, and that's where credit insurance in respect of your substantial customers can be key. I've recently dealt with the administration of a large recruitment company who had 90% cover on their debtor book, and this was hugely important in the rescue, in that it encourage the bank to support the administration and provide ongoing trading support whilst we sold the goodwill of the business. And there was a hugely better result for all participants in that scenario. So that's really just one example. Clearly, it's basic good housekeeping to have proper terms and conditions of supply and to enforce those conditions and make sure people pay on terms. Also, make sure you ensure the soundness of what I'll call your counterparts, both customers and suppliers. So use financial monitoring products offered by banks or accountants or credit referencing agencies. Check the reputation of potential customers within the industry. And perhaps in larger companies, you can look on for average payment day disclosures which are required in accounts. And the same really applies to suppliers, because you don't want people disappearing at critical times when you need supply. Also consider taking on product and employee liability cover so that issues which can arise in that area don't cause non-payment problems. Also, another part of cover that you can consider is to cover health and safety issues. Costs relating to damage to property and employees can be actually at catastrophic levels and lead to business failure on their own. So therefore, to have proper health and safety policies, conduct regular risk assessments, establishing a health and safety culture and holding cover on that can hugely reduce costs. Also, good idea to protect your intellectual property, make sure that's registered. And as a general rule of thumb, try not to enter long business premises that do not have regular break clauses which allow you to maneuver your position. Next slide, please, Tom. So in terms of funding, we've heard from Dave about C bills and B bills. The only comment I would really add to that is we are aware in our profession that HMRC are looking retrospectively at a lot of these loans and what they've been used for. So always good to be on top of that and be able to provide good notes and rationale for the use of those loans in case any problems arise in the future. In terms of investors into your business, whether that's third-party investors or indeed your good selves as directors and shareholders, always make sure that you document that investment, that you have proper agreements, and you may even issue debentures, both to third parties and indeed to your good selves, to make sure that investors are properly protected and are potentially at the top of the list for payment if there are any difficulties. Invoice finance, as a general rule, only requires personal guarantees from company directors in respect of any shortfall on those finance facilities, as opposed to PGs for sort of gross amount of finance in asset finance deals, etc. Dave referred to earlier the need to be very careful about the level of your HMRC debt, because this is something that lenders are now starting to look at. And the background to that is that the Finance Act in 2020, which was effective from December last year, reintroduced the concept of Crown preference in the event of an insolvency of a business. What this means is that HMRC are at the top of the list for payment in respect of VAT, PAYE and employee NIC for an unlimited time period. And they rank ahead of floating charge lenders. So lenders who are not secured on fixed charge security such as property, but on floating charge security, now fall behind the VAT man in the pecking order. And therefore, this is causing lenders to review their lending criteria and being very interested in the level of HMRC debt in a business. Otherwise, other methods to maximize funding coming into a business can be to explore what you may be able to get in terms of R&D, tax credit returns. And indeed, I'm aware of some products now appearing where similar claims can be made in respect of GDPR expenditure, and happy to provide links for anybody interested in that. And take the opportunity to use no-win, no-fee specialists who will review your entire portfolio of utility, insurance, key supplier costs, etc., to see if there's any gains to be had there. And there are also experts out there in the field who will review the terms of commercial loans to make sure that you're not being overcharged. Also look to reduce employment costs where you can, by perhaps having your employees continue to work from home. That's an opportunity to reduce your accommodation overheads, of course. And be mindful of the costs of redundancies, because where you've got a long-serving workforce, the costs of pay in lieu of notice, redundancy entitlements, etc., can be substantial. Loans are available from the redundancy payment service to help with these costs, but they can take at least 6 weeks to arrange, and they're repayable over 12 to 24 months. Can we go to the next slide, please, Tom? So I believe that we're now entering a critical phase in the recovery from the pandemic, in that as of 30th of September, which I'll come to shortly, most of the government protection against enforcement by creditors will fall away. So we are now in an arena where it's absolutely key to approach the key players in your business, whether they're suppliers or landlords or HMRC, investors, etc., and to look to negotiate with them about how matters will be resolved. Now, where landlords are concerned, you may be aware that as of 21st June, the government actually issued a consultative paper as to how COVID arrears of rent will be addressed, purely those arrears, and made some statements around landlords being expected to share the financial impact with tenants, but also said that tenants must begin paying as soon as restrictions are lifted. Now, it's my understanding that the government is looking to create a formal mediation framework for those matters to be resolved, but it is yet to become clear what the form of that will be. But it also appears likely that there might be similar frameworks in terms of trade and commercial debt, and that's something I think we need to look out for. I would very much urge everybody, as Dave has done earlier, to use your advisor networks, or the networks available to your advisors, because your accountant, your banker, your solicitor will know lots of professionals who are acting for the key players potentially in your business. So they might know your landlord solicitor, they might know a key supplier's solicitor. These are all handy contacts to have in the event that you need to negotiate. But when you come into that position, if you do, be in a position to set out clear comparative outcomes between your business being granted time to pay, and the likely outcome for creditors in the event that there is a forced cessation of trading or formal insolvency proceedings. Utilising the services of a restructuring professional may help you with this, because they will be able to provide you with the comparative statements and generally, hopefully, lend credibility to the position. If we could go on to the next slide, please, Tom. So during the 2020 period, we had two major acts affecting enforcement: the Coronavirus Act and the Corporate Insolvency and Governance Act. So these introduced suspensions on the issuing of statutory demands and winding up petitions, which has been extended out as we've gone through the pandemic, and it currently due to end on the 30th of September. So at the moment, it's for the court to decide whether a statutory demand or a winding up petition would be accepted. And it's for the petitioner or the issuer of the statutory demand to convince the court that the debt at issue is not COVID related, i.e. it predates March 2020, or there are some individual circumstances which prove that it was not or is not affected by COVID. Clearly all that will now drop away on the 30th of September. There's going to be a backlog and a delay, clearly, if a lot of matters are then issued, but there is now, then will be a situation where there's no legal protection against enforcement. Commercial evictions have been suspended until 25th of March 2022. And as I referred to earlier, there is draft legislation to deal with COVID rent arrears currently being produced. Wrongful trading has been suspended, or was suspended, until 30th of April 2021. The government's thinking in this was to remove pressure on directors to potentially close otherwise viable businesses for fear of potential personal liability for continuing a business when their knowledge was that they may not necessarily be able to pay debts incurred as a result. And the government were keen for directors to keep being able to pay utilities and order stock, etc., without risk of personal liability. But as can be seen, that protection has now already expired, and the protection's never extended to general misfeasance. Misfeasance being really directors acting outside of their general fiduciary duty to always act in the best interests of the company and its creditors. It's a very wide sort of category of claim that a insolvency practitioner can utilize after the event to pursue claims against directors, and that's never been restricted. But it's never been so particularly publicized as not having been restricted, which is a worry. So we go on to the next slide, please, Tom. So with regard to what I'll call lighter touch rescue processes, the recent legislation in 2020 introduced two new processes entirely. One which is referred to as a moratorium, which is a moratorium being really a legal stay or a ring fence to protect business against creditors. And that moratorium is available for an initial 20 days, can be extended to 40 days, and indeed beyond with the sanction of the court. But it's entirely in order to explore the feasibility of a company entering a formal insolvency process, which will result in the rescue of the company as a going concern. So the prerequisite there is that the monitor of the process, who is a licensed insolvency practitioner, will oversee the efforts by the company and its directors. But if at any point it becomes clear that the business cannot be rescued as a going concern or can't pay its ongoing debt, notwithstanding that it's in a ring fence, then the process would fail. So it has a high bar of needing that going concern requirement. We've also seen a new restructuring plan known in my profession as a cross-class cram down, and that's used by businesses seeking to recover, to use the courts to bind dissenting classes of creditors. You may be aware that this happened in the case of Virgin Atlantic last year, where there were various appeals by landlords against the reduction in current rents and small dividends in respect of past rents, but those objections were brushed aside and rejected by the court. Then in terms of what was already on the statute book, since 1986, both corporate company voluntary arrangements and individual voluntary arrangements have been around, and they are arrangements by which individuals or directors can put a plan to their creditors with really an infinitely flexible range of terms available to say how they will go forward, and still under the control of the same management. And hopefully, because this is not a terminal or formal insolvency process, keeping things like sector accreditations alive, to utilize their assets and income going forward over a defined period to address their debts by way of a full and final settlement, usually based on what will be received over a period of time. There's been some high-profile cases recently where landlords have been challenging CVAs, largely again due to attempts through the terms of the CVA to adjust rental terms and chop down historic rent claims. But in the most high profile cases of New Look and Regis, those appeals by landlords have been rejected, albeit that appeals against those rejections are now expected. So on to the final slide then, please, Tom. So if after all the mediation and negotiation and the attempts at light touch insolvency, things are still not looking good, but you still have a viable business with a good core that if it was detached from its existing debt, it could go forward, it could be viable, and there's value to it, then it's possible to use formal insolvency processes, including pre-pack administrations, standard administrations, and creditors' voluntary liquidations, to assist with viable restarts. Now, it should be said that these scenarios are heavily regulated and subject to close scrutiny, rightly so, because creditors need to know that that businesses are not being recycled and taken away for very little value, and that they, the creditor, are missing out. But with proper stewardship, it is possible to have, in the run-up to a formal insolvency, an accelerated sale process, which will involve independent marketing of the business and assets. And there will be an opportunity for current management to make a bid to reacquire at the other end of the process, but also all third parties will have an opportunity to bid, and there would need to be demonstrated full process of online marketing and database marketing of as wide a scope as possible to prove that every opportunity was taken to expose the opportunity to the market and obtain all bids. But the end result of that hopefully is that the business value is maximised, employment is preserved, and there is as big a possible return back to the creditors in the insolvency process. So I think that concludes what I want to say today, but very happy to take any questions that may flow from that.
Great, thank you very much, Colin, and thank you very much, Dave. We do have a handful of questions. If anybody in the audience would like to add to that, please feel free. Again, the Q&A button is at the bottom of the screen. So let's get to the first question, which has been posed. Dave, I think this one's probably for you. How do I improve my credit rating?
Very good question. As I mentioned in the presentation, it's quite often the case. I've recently dealt with, well, actually myself and you, Sherry, dealt with quite a large business, 12 million turnover business recently. And there were 3 directors in the meeting, and one was a full-time financial director. And surprisingly, they didn't know that their credit rating, business credit rating, had dropped from 86 to 30. So it's just really a case of staying right on it. There's 4 main providers of credit ratings in the UK: Dun & Bradstreet, Experian, Equifax, and Credit Safe. And what I would recommend is you speak first and foremost to your accountant, but that there are, and understand why the credit rating is low and what you can do about it. I won't go through the many different ways. It's just simply a case of looking at the past performance of the business, but also if there's any CCJs outstanding. But even simple things like sending your accounts into Companies House on time can have an impact, a detrimental impact. So I would say, first of all, speak to your accountant, but if not, there are specialist companies out there who will actually help improve it at a cost, usually a no-win, no-fee fee, and stay close to the business and keep you updated along the way as well. So it is possible to do it, but you know, it does depend upon the performance of the business.
Thank you, Dave. Colin, I think this one might be for yourself. At what point should I seek professional advice regarding cash flow and debt?
Well, the simple answer to that is as soon as possible, because experience has told me over many years of dealing with such matters that so many more solutions can be brought onto the table if a problem or a potential problem is identified as soon as possible, because if a trend is spotted and you seek advice, then you can look to see what restructuring, what refinancing, what other expert help can do to help your business, and react with that kind of team in place, rather than wait until you get to the point where enforcement is gathering, creditors are gathering, and the options become far less. Yes, we can use some of the processes I've mentioned to deal with that and to help maximize the return, but the earlier you yourself come forward, or your advisors raise a flag for you and get you to come and get advice, absolutely the best, because then yes, we can help, but we can also refer you to many other experts who can add to the situation for you.
Thank you, Colin. A similar similar question, but I think it's open to both of you really. What do businesses do if they are unable to repay bounce back loans and are needing to close?
Do you want me to go first? I mean,
Yeah.
what I would do there is a bounce back loan would be, like I said in my presentation, it would be a bank that's provided that facility, and just be as open and upfront with them as you possibly can do, and explore those options of spreading the payments out as far as you possibly can do, and just being open and honest. The last thing you want, really, you know, I used to say this when I was sitting in front of businesses as a banker, the last thing you want is you know, for me to submit an application or a report and then for something else to come along that we didn't know about, that you did know about. So it is just being open and honest and upfront, and, you know, just using the help that's available to you. Colin?
Yeah, well, a couple of thoughts come to mind really is that we've heard of a lot of instances of people simply trying to strike off businesses that have got a bounce back loan that they can't cope with, which really is contra to the current requirements about strike off, in the sense that that requires you to write out to all creditors and effectively seek consent, and the suspicion is that that's not happening. But I think we've also heard that legislation is about to be brought in by government to stop strike-offs in the event of there being an unpaid bounce back, so that's worth thinking about. The other thing is that be careful and take proper advice if you're going to shut a business because of a bounce back, because if there are deeper issues in terms of what's happened in the last year or two, and you've got, say, a large overdrawn director's loan account in the company because of the scenario that's developed throughout COVID, then if the company eventually finishes up in liquidation, you know, you might have an insolvency practitioner coming after you for that money. So do take advice. It's back to the same old mantra really of, you know, talk to your professionals and get advice.
Thank you. And we've got another question. What are the other effects of the Finance Act 2020? Colin, I think that's you.
I'll happily hand that over to Colin.
So, well, I think the one that I would really sort of point out there is that a formal provision has been introduced whereby if in the within 5 years there's been a director's been involved in 2 formal insolvencies where there's evidence of the taxman not being paid, and that's really been a principal issue in those companies, there is provision in terms of debts from July 2020 onwards for those that indebtedness now to be imposed on the directors personally. So, you know, it's a question of being aware of, you know, what's gone on in the past, and then being aware that because the noose of, you know, the HMRC trying to avoid tax avoidance is tightening, ever tightening, and the pressure's on now for government to get back as much money as it's been spending in the pandemic. That provision is sitting there, and we can expect the issue of what are called joint liability notices to directors on that. So it's something you need to be talking to your accountant, your tax advisor about, to some degree, our good selves, because we get involved in the mix. And it's just another, you know, potential risk that business owners need to be aware of.
Thank you. One for you, Dave, I think. If I can't get a recovery loan, Would I need to give personal guarantees on other business loans?
Really good question, this, and I've had quite a number of conversations with business directors or owners of businesses saying, I want a business loan, but I'm not prepared to sign a personal guarantee. My answer to that really is quite simply that you've got to be very, very careful when you actually approach a bank or a lender to say that you're not signing a personal guarantee, because effectively you're saying that you've not got the confidence in the business. So what do you think the answer is going to be as regards the whether the loan would be approved or not? Really, most of the time they would actually not approve it. The thing to think about is that basically a company has got limited liability. So if the limited company can't pay that debt back, then they would want to then revert to the directors to a personal guarantee. If they haven't got that, then basically they've got nowhere to go. So and the bank will always want to know that the directors have got a vested interest in helping to save the business. And if the business has signed a personal guarantee, then that basically is in place, that the director is not going to just throw the keys at the bank and say, you sort it out. So it does help in terms of actually getting the facility, but also as well, you are then offered independent legal advice as part of the process to understand it. But there are also ways to ensure that liability as well. There is insurance available, and you can go to companies to get insurance to cover that debt as well, cover that liability under the guarantee. But I would just counsel everybody to think very carefully and negotiate. You know, sometimes it might be that the bank might say, right, it's a 100 grand loan, we're just happy to take a 20 or 30 grand guarantee from you. So just be honest up front and talk to whoever, obviously talk to us before you do it.
Thank you, Dave. And another question for Colin. Can the panel please advise what legislation is planned regarding COVID arrears owed to landlords?
Right, well, I think the current answer to that is it's not clear, but from the sort of quotes coming out of government that I think I referred to earlier about the shared burden between landlords and tenants, what appears the framework will be is that that there will be private arbitrators who will be appointed. They will have to prove their impartiality, and there will be a scheme which will then, if it's gone through appropriate negotiation, it relates to, I have to hasten to add, only rent arrears between March 2020 and July 2021, but it would be imposed and would be legally binding. So, and I think that's what everybody's really looking for is a degree of certainty as to what that position will be, because the alternative obviously is that you do your own negotiations as not part of a legal, a bespoke legal process. Yes, you can use sort of clever lawyers to try and put together agreements that should be binding, but better to have a legal process that's known to be binding in law. And I think that's the aim.
Thank you, Colin. Well, that's really concludes our question and answer session. We've answered all the questions at this stage. What I'd like to do is thank both Colin and Dave for their time in preparing for today and in answering the questions which we've just heard. You'll be sent a copy of the slides and a copy of the recording. And if you need any support at all from the Growth Hub, please do contact us. You can see on the screen there the email address. And also, if you need support from Colin as well, he's offered to follow up with anybody who needs specific support as a result of this webinar. Absolutely. So thank you very much to everybody for arranging this. It's been very interesting, and it's very clear to me that this is a moving feast at the moment in terms of changing legislation, and it's important to take early advice if you're having problems. So please feel free to contact the experts. Many thanks.
Goodbye.
Bye now.